small, that every asset has a duration of 3. What if they have, so 120 divided by, let's say they have 3 assets, that would mean 40 million. What if they had 40 million that had a duration of 4, 40 million that had a duration of 3, and 40 million that had a duration of 2? What would the average duration be? 3. What if they had 50 million that had an average duration of 3, and let's see, so that leaves 35 million that had an average duration of 4, and 35 million that had an average duration of 2? Your weighted average duration would be 3. Okay? You do the same thing for liabilities. So what is the duration and how much do you have invested? So it's the weighted average duration. And the duration is 2 for liabilities. So we have more invested in assets than liabilities, and our assets have a longer duration. Okay? What happens, and the rate starts at 10%, what happens to our owner's equity if interest rates rise 2%? All right, the change in owner's equity is equal to the opposite of 3 times the 2 percentage point change divided by 1 plus the beginning rate of 10% multiplied by 120 million total assets. And we get assets will go down. If rates go up 2%, assets will go down by 6.5 million. Now we're going to do the same calculation for liabilities. The opposite of 2 years times the 2 percentage point increase divided by the 1 plus the 10% beginning rate times the 100 million, and we see that if interest rates go up 2%, liabilities go down 3.6 million. So if assets go down 6.5 million and liabilities go down 3.6 million, our net worth will go down by 6.5 minus 3.6, 2.91. Remember that our assets are going down, that's a bad thing. Our liabilities go down, that's a good thing. So the liabilities go down, but not by as much as the assets, and so our owner's equity will contract by 2.9 million. So once again, you have to look at the formula, and you go, whoa, what the heck? But then when you see an example, you see that it is not complicated. Put the formula on your card. All right. There are some issues with duration. Just like for gap management is very useful. It's very interesting, but it's not perfect. Okay? Duration is very useful. It is very interesting, but it is not perfect. The main issue with duration is that there is not a purely linear relationship between changes in rates and changes in the price of a financial instrument. We cannot, over the life of a portfolio, forecast perfectly how a portfolio is going to change if interest rates change. Okay? Duration helps us, but duration does not stay steady over the life of a security or a loan. Okay? So convexity tells us that the level of interest rates and the term to maturity affect how the price of a financial instrument will react. We're not going to get into the tall weeds of convexity because that is really a topic for advanced bond or fixed income or debt management. But you should be aware of what convexity is in finance. Convexity is a shape. It's a type of curve. Okay? So what this tells us is that you have duration, but duration will change based on how high or low the beginning level of interest rates is, and duration will change as you move along the term to maturity. As the term to maturity gets shorter, duration will get smaller. Okay? The higher rates are, and the longer the terms to maturity are, the more a price will change in response to a change in interest rates. Okay? That is convexity. Okay? So an asset or portfolio having both a low duration and low convexity will have smaller interest rate or market risk. A portfolio that has both a high duration and high convexity will have much more interest rate risk. Okay? So as we can measure convexity, which helps us be more precise with our duration and more precise with our forecasting. But once again, that's beyond the scope of this course. Okay? So convexity helps us be more accurate with our forecasting. All right, there are other challenges with duration. Sometimes it's difficult to find assets and liabilities that have the same duration. Okay? So it's not always, you don't always just snap your fingers and close the gap. Okay? Some assets and liabilities have patterns of cash flows that are not well defined, like a common stock. Okay? A common stock or commercial real estate or business, those cash flows are not nearly as easy to forecast as a loan or a bond. For a loan, if a customer decides to prepay the loan, that changes the timing of cash flows, which changes the duration. If a customer defaults on a loan, that changes the timing and that changes the duration of cash flows. So these are issues that you have with duration. Okay, we're finished with chapter 7. Great stuff. Last chapter we're covering here, at least in this semester. And regardless, if I were to cover, there's a second chapter that covers interest rate management and hedging with securities and options and derivatives. We're not going to get into that right now. But regardless, I would only test you on this one chapter because there's a lot of material in this chapter. So please pay close attention to the homework. That will help you for the exam. Peace out. Shalom.